Good afternoon, and welcome to Elevate Your ROI, Strategies for Taking Tech Investments to the Next Level. We thank you for joining us. I'm Naomi Snyder, the Editor-in-Chief at Bank Director. This webinar is brought to you by both Bank Director and Mantle. Bank Director is an information resource to the financial community, focusing on strategic issues most fundamental to a bank's CEO, senior leadership team, chairman, and independent directors. Mantle builds market-leading account opening software for consumers and complex commercial businesses, all to help banks and credit unions grow up to 78% faster and 4 times more cost-effectively. We are offering CPE, or continuing professional education credits, for this webinar. In order to qualify for credits, you must be in attendance for the full and complete webinar, and you must participate in all the polls. If you have not yet indicated your desire for CPE credit, please email Taylor Zito at tzito@bankdirector.com. Certificates will be sent out 2 to 3 weeks after the webinar. Before we get started, let me share just a few things to keep in mind. First off, don't worry, we can't hear you. You have joined this webinar in listen-only mode. We recommend that you click on the slide bar at the bottom of the screen to adjust between the presenter and the presentation. If you have questions for our speakers, please note them by clicking the Q&A button found on the right side of your screen. You can do this at any time during the presentation. Once our presenters have finished with their talking points, we'll have a Q&A period where those questions will be addressed. There is no need to take detailed notes, as the presentation will be shared with all attendees within 24 hours via email. It will also be available on bankdirector.com. If you have any technical issues, you may also note those using the moderator chat feature on the right-hand side of your screen, and we'll do our best to take care of that. Regarding our polls, those will also appear in the sidebar near the Q&A button. When you've selected your answer, just hit the Vote button to submit your response. Finally, and as always, the opinions expressed here in this webinar are those of the individual speaker only and don't necessarily reflect the opinions of others. On that note, let me share a little bit about our speaker today. Nathaniel Harley is the CEO and co-founder of Mantle. Founded in 2016, Mantle's mission is to expand access to financial services. Nathaniel Harley is a serial entrepreneur. Before founding Mantle, he founded and invested in several startups and began his career in investment banking at Goldman Sachs. So Nathaniel, please take this away.
Awesome. Thank you so much for the introduction. Give me 1 second while I share my screen. Perfect. Hopefully everyone can see that. So good afternoon. I'm Nathaniel Harley, co-founder and CEO of Mantle. Really excited to be chatting with you all today. I think the topic of how do you evaluate but also elevate your ROI is one we hear very often, and there's a lot of complexity in actually figuring that out. So excited to sort of talk through and think through how we look at it, and hopefully you'll leave this conversation with some very actionable takeaways. You know, one of the things that we see by and large is that a lot of banks and credit unions really approach technology as an expense rather than an investment. And so what typically ends up happening is they're actually choosing a check-the-box solution that, you know, may theoretically do all the things that they want, but ultimately fail to deliver real value and real results. And we are a very outcome-driven organization. At the end of the day, your success is our success. And so in this session, we're going to explore the current state of deposit origination, some best practices for vetting vendors, the actual components needed for a good digital account opening experience, and how to set benchmarks and determine ROI for what you should expect from your software investments over the 3, 6, 12-month period and beyond. And so before we jump into it, I just wanted to give a quick background on Mantle and how we got started. So at a high level, Mantle is a fintech company that helps traditional FIs modernize and grow. Funny enough, we actually started in 2016 building our own challenger bank. And when we embarked on that journey, we quickly realized that there was a way bigger opportunity to help bring our technology to the existing institutions to really help them level the playing field so that they could compete with the money center banks and the fintechs that were popping up. And so fun fact that the name Mantle comes from the part of the earth that wraps around the core, and that's very key to our strategy, and that we launch products on top of the core and integrate real time into your core banking system. And our flagship product is really our omni-channel deposit origination platform, and we've helped our customers raise billions of dollars of deposits each year and hundreds of thousands of accounts. And so today we're going to talk about a few things. Number one, how should you think about ROI? We're going to talk about the two prominent strategies we see that ultimately do drive ROI. I want to walk through how that math actually works. And then I want to talk about how do you choose the right partner in this journey of, not only account opening, but digital transformation. And so I want to start by asking you this. How should you think about ROI? What does ROI mean? And so the way we think about, and really the way we calculate ROI, is by really looking at the cost savings you get plus any incremental revenue over the cost of the solution. And this is the equation we constantly come back to. And then I think what's missing from that calculation, which is super interesting, is there are all these intangible benefits that your customers and employees actually receive through better technology. And I think there's actually something somewhat existential about this, where the cost of not updating your technology could be life or death. And it's really important to be providing your customers with a best-in-class experience, as well as your employees with that best-in-class experience. So it all sounds great, but where do you start, right? And we hear this time and time again, and mainly because there's just a lack of visibility on actual numbers, and it's really hard to assess where you are today and what the performance is. So I'd like to suggest 3 steps when embarking on this journey. And the first one is definitely the most important. It's really, in order to achieve ROI, you have to define what you are trying to achieve. You have to define what your goals are. And so this could be, we're trying to raise $250 million of deposits in the next, year or 2, 3 years. It could be, we want to close X number of branches. It could say, we want to decrease our efficiency ratio from X to Y. It could be, we want to, pay down wholesale funding, or we want to expand into new markets or tap into different market segments. But it's really important for when you start this journey to have defined goals, because ultimately that is what's going to help you choose the right solution. So because we're going to be looking at metrics that really drive business outcomes and fuel growth through the deposit origination lens, first wanted to just ask a couple of quick poll questions to better gauge everyone on the call's goals around deposit origination. So we'll have 3 of these. And the first poll question we have is, what is most important to your institution over the next year with regards to raising deposits and the core deposit business? Waiting for some results to start trickling in. Interesting. So I'm starting to see that, deposit growth is definitely number one, which makes a lot of sense. Obviously there's been a ton of liquidity in the system over the past few years. And, I think, obviously there's some concerns of that starting to dry up, and we've obviously seen some liquidity leave the system. Love to see that improving operational efficiency is the second goal there, because that's something that's really actionable and can have really meaningful impacts on the institution. And then the next one that's popping up is improving the digital experience. And 100% agree. It's really important to have that digital experience be best in class. We actually think of the digital experience to really support not only the online channel, but the branch channel and also the relationship manager channel as well. So these definitely track with what we've been hearing in the market. So super cool to see. Okay, next. So I want to move on to the second question in the poll. So, given raising deposits is a top priority for a lot of you guys, how many deposits are you guys trying to raise in the next year? What's the deposit goal over the next year? I think what's really interesting about these results so far, and again, we hear this a lot, and the numbers are slightly changing, but definitely a decent percent haven't set a goal, which kind of goes back to the sort of first step. It's really important to have that goal in mind, because at the end of the day, you can kind of think about account opening as a lever, and you can turn it on, you can turn it off. You have a lot of flexibility with how many deposits you need to raise, but you ultimately need to understand what that deposit goal is at the end of the day. So that tracks, and I would just encourage folks on the call to really dig into that and try to understand, at least for 2023 and beyond, what some of those goals are. Awesome. So now I wanna move on to the last question of the poll. How do you intend to gather the majority of the deposits to ultimately reach that goal? What are your primary channels gonna be? Cool. So consumer core deposits has taken an early lead. Yeah, this makes sense. Starting to see a bigger weight on commercial core deposits, which makes a ton of sense. Yeah, I think a lot of this actually tracks with all of our conversations. Commercial deposits, SMB deposits are really the new core consumer deposits at the end of the day. Obviously, every institution sort of varies in their split between the two. But I love to see overall that core deposits are the focus versus obviously wholesale funding and broker deposits. Obviously it makes sense in the interest rate environment that we are in today. Okay, great. That's super helpful. And I think that sets a really good stage. And some of the case studies and examples that we'll walk through will help just kind of put a finer point on some of these answers. So we talked about step one, defining your goals. Number two is you got to determine which solution will ultimately help you achieve those goals, right? So now that you've defined them, how do you go about achieving them? What is the best solution to help you accomplish these goals? And we're going to use account opening as the example to really show you how to do that. And then the last step, it's really a matter of measuring the results. So it's really important to be able to have access to data to understand what's working, what's not working, where are the friction points, where are the areas of opportunity, because ultimately that is really how you continue to refine your process at the end of the day. So regardless if it's Mantle or any other vendor that you're using, having access to data, being able to generate these insights is really critical to being able to ultimately improve the outcomes that you are experiencing. And so I want to take a look at the two strategies that we see at a very high level most often that can ultimately really help you hit your goals and drive ROI in the account opening process. And so the first one is process optimization, and the second one is market expansion. And I'll double click on both of these, but both of these strategies offer real opportunities from both a cost savings perspective, but also from a revenue growth perspective at the end of the day. And so the first strategy we see a lot is process optimization, right? And this kind of harkens back to efficiency ratio that we saw in the first poll question. But really the goal with process optimization is to reduce the time and headcount required to open an account, reduce back office costs and dependencies. And typically banks are looking to improve processes so that they can ultimately have a positive impact on their efficiency ratio. And some of the main examples we see around cost savings are optimizing headcount. A big way you can do that is by automating your KYC and AML process. We also hear a lot about wanting to streamline the branch operations by either bringing parity to the online channel and the branch channel, streamlining how the jobs are being done, moving to a universal banker model, et cetera, and ultimately reducing some of the dependencies. Mitigating fraud is huge. Reduction in fraud is a huge cost savings. And obviously, if you're not stopping fraud, that can be quite, costly for the bank. And then lastly, marketing. It's real, optimizing that marketing spend, making the most of your marketing dollars. These are the really, primary cost saving opportunities that we see. And what's also really cool about this is these are sort of metrics that you can track. But ultimately, process optimization delivers a few intangible benefits. And really what those are number one, creating a superior best-in-class experience that you feel proud of. So when your customers, whether it's a consumer or business, go to your site, they feel like you're a modern institution and they feel very comfortable doing business with you. And then there's the other side of the coin. You want to improve your employee experience, right? Your most valued employees want to work at a place that they have the tools to do their job effectively, and they can spend less time just keying in information and more time actually building relationships and helping grow the business at the end of the day. And so that's process optimization. Market expansion, this is really the second strategy that we see a lot and we have a lot of conversations around. And really the goal here is to grow market share. It's to open up new geographies. It's to also access new customer segments. And what's cool about this is this can actually be done organically through your existing brand, but it can also be done through opening additional brands or, a digital brand or digital bank as well. And we'll kind of talk through some of those different options. And so when we think about revenue growth opportunities, obviously, and we kind of mentioned this, but increasing penetration of existing markets is huge. We want to grow your customer base. We want to expand into higher value markets. And we want to be able to launch new products, right, for different segments. And there's also a lot of cost saving opportunities here. You can get access to lower cost funding. There's an ability to really reduce branch costs or even shut down branches. One of the phenomenons we've seen is something called the halo effect, where you basically increase your branch's serviceable radius. Many banks also typically see lower customer acquisition costs at the end of the day. And it allows you to go after new segments where it's actually cheaper to acquire new customers, or you can pursue a digital strategy where it's cheaper than acquiring a customer in person. And then same thing as before, there's a ton of intangible benefits depending on your goal. So for example, you can capture a new customer base. We hear a lot that, our average customer is over the age of 50, 55, 60, and we want to future-proof our bank and we want to, attract a new customer base if you have aging customers. We also, we also hear a lot of talk about expanding your brand regionally or nationally or into new customer segments. And a lot of that depends on, the current brand infrastructure and how much you think it will resonate in different markets or with different segments. And then there's a whole nother way to sort of skin this cat, which is just launching a completely separate digital bank, right? And I think two of the really cool things about that are, one, it allows you to test new technologies without, really impacting your existing traditional brand and, potentially cannibalizing the existing market. And there's also, you're able to reduce brand risk, right? It's more of a playground. You can try new things without, necessarily impacting that existing brand. And so that's the high level. That's sort of what we think about. But I want to bring this to life. I want to really dive into some real world examples for both of these categories. And I want to start with how process optimizations work. So the first bank I just wanted to highlight, I'm sure you've heard of Lending Club. They position themselves as the only full spectrum fintech marketplace at scale. They have over 4 million members. We actually met Lending Club originally when they were Radius Bank. And when we first met them, their goal was to replace their legacy account opening provider so that they could improve conversion rates, they could increase automation, they could reduce fraud, and they could feel more comfortable spending marketing dollars and knowing that those marketing dollars were being spent efficiently. And so they were really focused on a number of things. They wanted best-in-class user experience, and the way they really judged that was based on conversion rate. And also, they wanted a time to open an account. They were doing, it took 10 to 15 minutes to open a consumer account. They wanted to be able to open in less than 2.5 minutes. They wanted to drive a lot of automation in the KYC and AML process because a ton of applicants were going to manual review, and they had a pretty significant headcount burden to manage all those applications. They wanted a real-time read and write direct core integration so that they didn't need to be, keying in additional things and all, everything sort of worked smoothly and was automated. And then they wanted to integrate with best-in-class fintech solutions. And so the results they saw were honestly amazing. Number one, they were able to optimize headcount. They saw about a 71% reduction in account review costs. They were able to take the team from 7 people who were reviewing applications to 2 people. And they also optimized their marketing spend. So they saw their conversion rates improve about 4 times, which meant that every dollar that they were spending was 4 times more efficient at the end of the day. They also saw about a 67% reduction in fraud, so huge savings from a fraud loss perspective. And then lastly, they really improved the employee experience. And what they were able to do was repurpose that headcount that was reviewing applications and needing to constantly talk to the customers into higher value activities like customer relationship management and also data analysis that really allowed them to hone in and say, all right, what marketing campaigns are leading to the most conversion rates or the most frauds and fraud attempts, and really double down on that. That was Lending Club. Another great example is First National Bank of America. They have 3 branches in Michigan. They're approximately $3.2 billion in assets. They're on the Jack Henry CIF 2020 core. And their goal was to scale a national strategy through automation. They wanted to be able to scale, add more accounts, add more deposits, but not add additional headcount. And so, they needed a solution that was able to have a dynamic approach to raising deposits while keeping the, time to open an account below 5 minutes. And so depending on the month, they wanted to be able to raise as much as $45 million or as little as $6 million. And they wanted to be able to turn that on and off. They really were focused on high conversion rates because that eliminated the need for additional marketing spend to drive high volume and also really allowed them to add strategic flexibility on a month-to-month basis. And then lastly, it was a must that they had auto decisioning capabilities so that they could process a very high volume of applications without additional operational support. And so again, results were amazing. They averaged about $15 million of deposits per month. I mentioned how they sort of fluctuate, but they really, treat it as a faucet. They saw an average initial deposit amount of $75,000, which is huge. And then they saw about a 90% auto decision rate. So 90% of applications that were coming through were able to be automated from an approval or denial perspective. So really, really awesome results. And so that's on the process optimization side. I now want to move to the market expansion side and look at some examples in practice. And so first, let's look at Midwest Bank Center, MBC. They're a 113-year-old community bank in Missouri, roughly $2 billion in assets. They're on Jack Henry Silver Lake's core. And when we started talking to them, they had a few goals that were really centered around accessing cheaper financing and also expanding their customer base. And so number one, they wanted to replace wholesale funding with core deposits. They had about a $100 million year one goal. They wanted to attract a younger demographic more effectively. They wanted to avoid cannibalizing their current customer base, given the higher rates they were planning to offer online with their digital-only brand. And they wanted to upgrade their tech of their legacy bank and build a new competency, and do this by first starting with that, sort of sandbox I mentioned with the digital-only brand, and then migrating their, traditional brand over. And so, as I mentioned, the approach they took, which I think is becoming more and more popular, is they actually created a completely separate brand called Rising Bank. And so Rising Bank was an online only brand. It would only target customers outside of the bank's existing footprint. So they had geofencing to not cannibalize their current market. And they were able to launch this digital brand in 6 months. And I think what's really important is they had involvement from all the key stakeholders, not just the executive team, but they brought technology and compliance and deposit operations into the fold very early on in the process, which helped get a lot of buy-in and focus around the business outcomes. And so what they did is they started with a high yield savings account and CDs because there was lower fraud risk, it was more straightforward marketing, and they could acquire very large amounts of deposits at an equal to or below cost of wholesale funding. And then they added checking accounts later. And then once they got comfortable with that full suite of DBA products on the Rising Bank brand, they then launched it for their traditional brand at Midwest Bank Center. And so what they saw is, they were essentially able to raise 10 times the amount of deposits through their digital brand as they would have through their top performing branch, right? So they raised about $500 million in 5 months with an average funding amount of about $55,000. And that was better, as I said, than their top 10 performing branches. They were able to attract 2,000 new customers. But what's even cooler about this is 10% were under the age of 25. They had significant automation, which allowed them to scale and keep, headcount pretty limited. I think they had 1 to 2 people that were launching the digital brand. And as I mentioned, they use this as a way to get the traditional brand up and running. And once they launched the online account opening with the traditional brand, they actually drove roughly 20% of new accounts digitally and 60% of new customers. And we'll talk about Flushing in a second. But I think what that really emphasizes is that there's all this latent demand built up. And the last thing that they saw is what we refer to as the halo effect, where basically they saw a 2x increase in the branch service area. So typically the service area was about 3 to 5 miles from the branch. That increased to 7 to 10 miles, once launching this online platform for their traditional brand. So really, really awesome results. And I want to look at the last example on the market expansion, which is slightly different and a slightly different approach, which is Flushing Bank. 90-year-old community bank, $7.1 billion assets, 21 branches in New York, FIS, Miser Core. And when we set out, they really wanted a cost-effective way to expand within their existing footprint. They wanted to open almost exclusively low-cost checking accounts. They were very focused on minimizing fraud. And they said, we want this branch and digital branch to be competitive or better than what we can do in our best performing branch. And so, similar to the Lending Club example, they replaced an outdated account opening technology solution. They already had really great marketing in their network. They had a really strong brand presence. They had really good existing out-of-home marketing. They had a really strong branch network. And so they already had a lot of that baked in. And they started only with checking accounts. And they decided to launch just within footprint and focus there, but also allowed traffic outside of it to see what they would get. And so what happened, and this is super cool, without spending any additional dollars in marketing, they saw 19% of accounts were now opened online digitally. And so that speaks to all this latent demand that was just built up. And instant performance in month 1, it was easily opening, more accounts than their top performing branch and really better than multiple branches in terms of performance. They saw average funding about $9,000 per account and $5,000 per checking accounts, meaningful cost savings per, account book. And they went from 75% of applications going to manual review to just under 10%. So huge automation and savings there. And so those are examples that bring it to life, and I hope that gives you a flavor of the types of things that are possible. Obviously there's more to that, but I want to walk through cool, those are great examples, but how does the math work, right? How does this actually work in practice? How do I justify the ROI of a solution at the end of the day? And so I want to start with a simple example. Take these numbers to be illustrative, just for easy math, use round numbers. But let's start with a goal, setting out, we want to raise $100 million of deposits, right? A lot of you said deposit raising is a big goal. And so let's just assume the initial deposit is 10,000 per account. We obviously see that, all the time, especially with our more checking account focused products. And so let's just say you have an average balance of 10,000 when you open the account. You need 10,000 new accounts to drive the $100 million of deposits. So I'm going to walk you through the cost saving opportunities and this actual savings you get per line item. And so first, let's look at optimizing headcount. So perfect example, we had a bank that reduced BSA from 7 to 2 heads. And right there, the 5 head saving is roughly $250,000 worth of savings, right? 5 people at $50,000 per head, that's pretty significant at the end of the day, and in some ways probably pays for the solution itself. Then you incorporate fraud. What if we could reduce fraud by 67%? Let's say, let's say today you're experiencing $225,000 of fraud loss. Now that might sound very high to you guys, but let's say we're able to cut that down by 67%. Great. You have about $150,000 per year of savings, right? So that you can see how significant that can become. Conversion rates are so important. I cannot emphasize this enough, how important conversion rates are. And really, a high-performing solution can improve your conversion rates by 4x, which ultimately would translate to $750,000 in annual savings. And here's how we calculate that. So let's say you're using an existing solution today, and you're getting a 10% conversion rate. The number of applicants, 10% of them are actually converting. You would need 100,000 applicants to get to that 10,000 account number, right? And your marketing spend in this situation is about $10 per application, which means you're ultimately spending about $1 million in marketing. So now let's say you 4x that conversion rate, and you go from 10% to 40%. Now you only need 25,000 applicants to drive that same 10,000 accounts. And at a rate of $10 per application, your expense goes down from $1 million of marketing spend to $250,000 of marketing spend, which is a savings of $750K. If you're able to drive the same amount of accounts and dollars and save $750K, if you wanted to keep that $1 million spend, you would be able to drive 4 times, right, the amount of accounts and deposits that you would ultimately want to do at the end of the day. And so now I want to talk about lower cost funding. And so a lot of what we're talking about now, and we've obviously seen in the past, is a way to raise direct funding through either savings CDs or core checking accounts and replace wholesale funding. We just use for whole numbers a 1.25% savings there. And so just based on that $100 million deposit goal, based on the difference in interest rate that you would get from wholesale funding or potentially direct, you'd save about a $1.25 million right there. And so finally, let's just say you also want to close a branch, right? And so we just said on average, maybe a branch costs you $250,000 annually. That's how much you're saving there. And so that brings your total cost savings to $2.65 million, which honestly is pretty significant. I want to go to the other side of the coin and talk about revenue growth opportunities. So the easiest one to look at is fee income, because let's just say, you generate about $100 per account. You're doing 10,000 accounts. That, adds up to roughly $1 million. There's also a lot of there's also a lot of upside in this number as well that we haven't illustrated here because it's a little bit harder to quantify. But because you're driving more accounts, you actually have more of an ability to upsell additional products to the customer at the end of the day. And the other thing is, if you're driving more deposits than you normally would have, you can obviously, fund more loan growth, which obviously increases revenue from that perspective as well. So wanted to call out the ones like fee income, which are really easy to quantify, but also wanted to highlight that there are a few, there's additional upside in this number as well. And so that brings your incremental revenue to about $1 million. And so what's the total ROI? Well, let's go back to our equation. Cost savings plus revenue growth gets you to about $3.65 million. Let's just say, I'm not saying this is the actual price, but let's say that the annual cost of an online account opening solution to open consumer and business and online in the branch, et cetera, is $250,000. Well, that's an ROI of about 14.6 times with a payback of under 1 month. That's huge. And so when you're trying to justify the spend, while you may be looking at a solution that is more expensive than what you typically have purchased in the past, it's really important to look at the cost savings and revenue this generates you, because if you can pay this back in under 1 month, it is 100% worth it. And I guarantee you that the CFO will make that decision every day of the week. And so as part of this, right, and kind of just mentioned it, there is a cost to not choosing the best solution, right? And it's not only a financial cost that we just spoke about it, but it's also existential in that you might not be around, right? It's really important to partner with someone who is constantly iterating, constantly making the product better, and is not only providing you with software, but is also a partner to you on your journey, because there are a lot of decisions to be made. There's a lot of strategy to figure out, and you want to make sure you're working with someone who knows the best practices, knows what the benchmarks are, and ultimately knows what will work at the end of the day. And so, and this is obvious, but not all partners are created equal. Profitability really does vary by partner. And I think it's really important to run this ROI model for each partner that you're working with, to see what the sort of, trade-offs and, positives and negatives are. And I love this quote from Grace Pace at Quantic, who was actually recently named one of ICBA's 40 under 40. And here's what she says. She says, define your strategy and keep it as your North Star. It's also important to find platforms that are partners, not just vendors. The digital space is changing so quickly, and you want to partner with someone who will work with you on that evolution. You might need to pivot really quickly or create a custom solution. And if your vendor is not willing to be flexible and work with you and share best practices, then you're on your own. And we obviously love Grace at Quantic and really, really appreciate their partnership. And so how do you even go about choosing the right fintech partner, right? We've defined our goals, and my question is, how do we actually choose the right fintech partner? And so there are a number of things that I would implore you to think about and really consider. I think number one, it's focus on integrations. Number two, it's properly vet the tech providers that you are working with. And then three, get the data and make sure they have the data you need to ultimately drive ROI. And so first of all, integrations are crucial. Nothing happens without access to your core. The middleware, the API access to your core, and any other systems is necessary to drive that full automation. Now, there are workarounds. The system can operate in coreless mode, but to ultimately, drive that full automation, getting access to your core, having a single sign-on integration with online mobile banking, integrating with debit cards, checks, all of these various things is really important, because that's how you'll get that efficiency and make your employees' lives way better, and also produce a real-time best-in-class experience. So the best time to negotiate this with your core provider is often when the contract is up for renewal. But I know a lot of the core providers today are sort of selling new middleware, and it's just really important that you have access to it and you make sure that they are playing nicely with fintech providers. And then I think, secondly, make sure your partner has in-house expertise for every integration. Without the right integrations, these products barely work, and you'll spend a lot of times, fixing bugs, fixing things in the core. If you have a batch connection that uploads nicely, it's going to really hurt the user experience and really dramatically increase that operational burden. So you want to make sure whoever you partner with has done this before, has done it on your core before, really has built that competency in-house, and isn't necessarily outsourcing it to someone who you might not have the most success with. And then second, it's really important to vet your tech providers. Number one, check references. Don't just believe what a vendor is saying. Talk to those references. Ask them, how has the implementation gone? Were they able to connect to your core? Were they able to connect to your core? Did they deliver actual ROI for you? Were they a good partner in your journey? Really important to actually talk to your counterparts and peers to understand how things have went. It's also important to look at SLAs, right? What matters here, does the fintech have an SLA or do they have an SLO, right? And that's, basically an agreement or an obligation. And, you want someone who has 99 99.99% uptime, and you want someone who is really holding themselves accountable to making sure they're providing you with the level of support you need. And then lastly, you want to make sure you're buying true SaaS. One of the key questions to ask here to determine is it SaaS or is it a custom solution is how many updates did the customer get last year, and were those updates substantive? Oftentimes what we'll see is when evaluating a vendor, the vendor might say, yeah, we'll give you everything you want, just give us an SOW. But the problem there is they're writing all these custom integrations and custom code for just you. And so now they're maintaining, let's say 100 different banks with 100 different code bases. And the problem is when I want to push updates to the product and make it better, I'm not able to do it. So you want a platform that's truly SaaS, one code base, multi-tenant, so that as we learn, as we get more data, we're constantly improving the product so that what you get on day one is significantly better, in year 1, year 2, year 3, and down the line. And then finally, you need to make sure you have the data that you need to drive the ROI you're looking for. You need to make sure you have real-time access to data and analytics, right? You gotta understand, is the vendor data literate? Do they explain concepts numerically or qualitatively? If you don't have access to good data, the solution is honestly useless because you're not going to know what works at the end of the day, and you're not going to know how it performs, and you're not going to be able to measure success or failure. And then real-time configurability is an absolute must, right? So oftentimes I'll hear, we wanted to change our interest rate, right? Interest rates are moving. A vendor charges $10,000 and quoted us 2 weeks. We're big believers in self-service. You should be able to go into what we call our digital branch manager, make edits to rates, products, copy in real time. You never have to contact a support person. It puts the power in your hand. Obviously, we're there to help advise and walk you through it if you need it. But ultimately, this is self-service, and these functions are at your fingertip. And so ultimately, what this comes down to is choosing a tech partner that can deliver on its promises. You can become a high-performing institution, and you will recession-proof your business. With the right technology in place, you can regain the competitive advantage, and you can be winning business over the money center banks and the fintechs, and really really understand what your key differentiator is and go after it in a hard way. And you can also pivot in response to whatever is going on in the macro environment. It gives you ultimate flexibility. And you can really turn the tap on during a liquidity crunch and turn it back off when deposits become a lower priority. And what's really key here is you can do all of that without increasing headcount. So that is a quick overview on evaluating ROI and how we think about it. I will pause there and I will open it up to any questions that the audience may have.
Thank you, Nathaniel. Just as a reminder, on the right-hand side of your screen, you can submit questions. There's a little Q&A button. Click on that and type in your question. I'll be checking for those. I had a question for you, Nathaniel. You're talking about implementation a lot and how critical that is to successful ROI, and I'm wondering if you have any questions perhaps you would ask vendors about their implementation process.
Yeah, certainly. So I think the first question is obviously, what is the process, right? What does that process look like? What are the different phases? And then I think secondarily, it's what are the best practices? Right? You want to be able to walk into that implementation, understanding what the process looks like, how long each phase in the process is going to take, and how much support you're going to get from the vendor in terms of best practices and, how experienced and how well versed in what they are that they need. We call this our implementation playbook. And look, it's tried and true. It's based on a lot of data from a lot of our customers, and I think we take a highly opinionated approach because, as I said, we know what works and there's no need to reinvent the wheel. There's obviously nuance within, the devil's in the details to some extent, but, there's certain things that just frankly work and work really well. And, you want to be able to have a partner that that can support you in that. I think you also need to have a testing and adoption process as well. It's not just enough to go live, but you want to make sure you're supported in the sort of soft launch and full go launch to make sure that, once this is live in the market, we're looking at the data, we're iterating on things that might need to be iterated all, within the first month, 2 month, 3 months post going live, so that we can come back and say, all right, did we hit the goals we set out to hit at the end of the day? Training is really important to obviously get there. We're big believers in our learning management system, and just putting the power in the bank's hands to be as self-sufficient as possible.
Yeah, that's helpful, because I hear that all the time, that there's that frustration out there when you have a partnership that doesn't work out in terms of your ROI, and fitting, focusing on those goals. And would you recommend that banks go through an RFP process when evaluating vendors?
Yeah.
Or skip?
So, look, I think it depends where the bank is in their journey. An RFP can be really helpful when just trying to sort of understand the full landscape of tech requirements and, what each vendor provides from a very functional perspective. I think the downside of it is takes time, it elongates the sales cycle, a lot more cooks in the kitchen. Time to value is obviously longer. And so, I think we've obviously gone through many, many RFP processes, and, I think it really depends on where you are. I think there's a way to evaluate vendors without going through an official RFP process at the end of the day. But that's just where some comfort lies. If you can get around it and you can get yourself comfortable, you will get to value faster. Like, promise you will get to a product decision faster, you'll get live faster. And so, it's kind of a cultural question at the end of the day. And really depends on where the bank is in their life cycle of evaluation.
Yeah. So, and where do you come on this question of custom, kind of like having a custom tech solution versus just going with, what the tech vendor has available? I've heard this, that there's no real custom tech thing, that you really just need to rely on what the vendors have come up with. But where do you stand on that?
Yeah, so there are a number of vendors that theoretically provide custom solutions in that, they will execute on SOWs and build specific features and, specific requests and things like that. What I'll say is, look, that's dangerous for some of the reasons that I articulated, because the perception of the bank may be, oh, I'm getting 100% of what I want, right? Because I'm asking for it, and the vendor is just basically building exactly what I want. But the reality is where do their expertise lie, right? And so I think from the banker's perspective, they're really strong at understanding their market, their value prop, how they do business, what the product offering should be, et cetera. And then you want to find a technology partner that has really strong opinions on how to increase conversion rates, how to drive deposits, how to get more efficient. And those are more outcome oriented at the end of the day. And in order to truly be able to deliver features and functionality that deliver on that, you need to be able to constantly update the platform, because you're constantly learning. You're learning from the data you're seeing across your banks. You're learning from the feedback you're getting from your partners. And so having an API first solution that's one code base and ultimately a truly modern SaaS platform like Mantle is built is really important to us, because it allows us to continue to evolve and move with a ever-changing landscape. I'll give you a great example, right? The fraud landscape is changing right beneath us, right? And there was a lot of account takeover activity, and if we had written custom code and custom solutions for all these different banks, we wouldn't have been able to literally overnight push a solution to all of our banks that stop bot attacks in its tracks, right? And so by having that one solution every bank gets the benefit of it. Now, that doesn't mean that configuration is not important. Configuration is really important. Like, you need to be able to determine your own products. You need to be able to determine what your CIP, CDD, enhanced due diligence is. You need to be able to write your own rules, but ultimately that's business logic. It's not, writing specific code and features. And so that's how we make the platform look, feel, act specific to the institutions that we work with, and really allow them to tap into how they want to do business, where they want to meet their customers, and the strategies that they want to execute.
Okay, well, that makes sense. So thank you for that explanation. So thank you so much, everyone. As a reminder, you're going to receive the recorded version of this webinar within 24 hours. We're also going to post on bankdirector.com, so you can find it there. Thanks so much, Nathaniel and to Mantle, for co-hosting today's webinar. And thanks for joining us today.
Thanks for having me.